open our meeting.
And we'll do a roll call. We'll start with Mike
Here.
and Tom here and Neil is here. And we have an opening that we have to think about filling before we. So,
Yes.
but 2 is a quorum, right?
2 is a quorum,
So-
and there's only 3 of you on the committee, and you're all 3 here, so we're good to
So
go.
we're in good shape. Okay, so how about minutes approval? Does anyone have any comments?
No. And my name's on the bottom.
Here. Excellent.
Okay, I have a motion to approve.
So moved.
Second, all in favor?
Excellent, thank you.
All right, on to our topic of the day, which is investment performance.
Yes.
You're gonna be coming out at this party and then at the board of finance too, so 2 presentations.
Right.
Yeah, lucky you.
Yeah.
With results like this, you must be eager to get to a place like this.
Absolutely. Yeah. Certainly unexpected. Hi, everyone. Brian Binkley. Good to see everyone in person, which is really nice to see.
Yeah.
So, yes, that's exactly what I had prepared. I can do a quick recap from the market perspective, or I could just jump into the performance of the plan. You know, the main takeaways from a fiscal year perspective, I put fiscal year, I put in July, and I do have an update through August. But, you know, phenomenal returns, up over 29% across all the, 26, 25%, all the 3 plans. So great shape. Certainly your funded status is really healthy and strong, probably the envy of a lot of towns in Fairfield County, but this will only help it. And then as far as the other sections I put in the book is that we often update our expected return on assets for the plan, given your current asset allocation and what our capital market forecasts are for those asset allocations. Not maybe surprisingly is that we see lower forecasted returns given the strong returns in the market and historically low rates. So probably no different from last year. And then I do have some topics as far as, our outlook, but I'm more interested in taking your questions, what's on top of your mind at the committee.
Yeah. I think summer coming up that we have to look at the discount rate, we take our decisions on
Right.
that traditional and any sort of other.
Do you have a, I apologize, do you have a soft copy of this, Brian?
Yes.
There is, I have a book, if you,
You guys have.
When I'm logged on, I could probably send it to them. I got into the network, so do you want me to send it to them?
yeah, it's on the
It's on the tablet.
tablets.
Oh, okay.
Yeah.
So you
but
can go-
just-
Okay, I don't have, I apologize, I don't have my tablet, I have my, just my email, but I can try to.
Okay,
I don't
No, but
think-
it's on your, it's under your regular agenda. It's in one of your subcategories for tonight's meeting.
Yeah, I apologize, I don't have my tablet with me, that's why.
Oh.
okay. Do you want to just email it to him right now? Is that
Should be able to do
possible?
that.
I do have, I'm sorry, I gave one to you. Let me give, Judy, if you want a hard copy too.
Yeah, I think it would be beneficial to go through the performance a little bit.
Yeah, let's maybe go through the
When we get to
presentation,
vote.
you'll hear it.
Yes.
sort of.
And, we have fiduciary responsibility to have 2 meetings a year about, and this is our first. So.
It's
Good, we're doing it.
the same
Right.
one that I've
But
already
if you
got.
want to see it in paper.
No, it's not.
Okay.
Better.
So,
Much better.
maybe like,
Let me email
go
you
through
his,
the form summary, and then how that leads up to some of the, and how good things can also start focusing on some of the bigger questions we're gonna have, like discovery.
Absolutely.
That's kind of the interesting point.
I'm glad to do that. I just sent it to you. Maybe it'll take a minute or so to get through to you, but I
Thank
have
you,
the
Brian.
Keenan.gov email. Is that?
Yes,
Yeah, okay.
that
good.
works.
So why don't we then start just to recap on the markets on page 4, the first page of the book. And this recaps the markets, both equity, fixed income. And I'll look on the left-hand side. This is not fiscal year to date. This is through July. But if I focused on the green bar, the tallest one, that's the 1-year return through July. And, reflects the strong performance in the equity markets, still coming off of last year. So you see US equities up 39% and international equities, which are also in the portfolio, up 29.6, so just shy of 30%. You know, the astounding thing here this year in 2011 is I think there's been 53 record highs year to date, just year to date in the US equity market. So 53, record highs. So, and, the trend has been there, continued as far as US outperforming non-US. And, that's reflected whether it's a year to date or the 1 year number on the far left-hand side of the paper. In the middle section is the fixed income returns. And, rates have, jumped around and done a lot this year. Came into the year at just 93 basis points, so really low. They spiked to 1.7% at the end of the first quarter, and people just thought that they were just going to keep running. But we kind of had that growth scare again and with the delta, and so they're back down to 1.3. So a lot of volatility in the interest rate. But the bottom line from a year-to-date or 1 year perspective, fixed income is negative returns. The US aggregate is down 0.5% year-to-date or 0.7% on a 1 year basis. That's again reflective of interest rates falling during that time. I'll look to the next page, page 5, that just starts to break into the market cap segments and the value and growth. And given that the town owns the total stock market index and the Vanguard total international stock market index, just as a reminder, you hold all of that. The total stock market index is over 3,500 securities, so it's large, mid, small cap value growth. And same with the total international stock fund that you hold, it's both developed and emerging markets. So while the numbers here on the page say on a 1 year basis showing small cap up 47%, well over 37 for the large cap stocks, and you see value on a 1 year basis up 40%, outperforming growth 36. That just doesn't talk about the rotation that's happened in the last 12 months. There's been a lot of rotation, growth outperforming for 6 months and value outperforming. And now the latest 6 months, it's flipped back to growth. So there's been a lot of market rotation with the segments of the market. And that's, again, a great reason to own the whole market instead of trying to time it because it moves so quick. Again, last year, you probably just remember just hearing about Facebook, Google, and those few tech stocks that were leading the market. And that was true, but that quickly reversed. Page 6 is just looking at the treasury curve. And this is just to highlight what's been happening with rates. Green line is what it was just about a quarter ago. And that dark blue line in the middle is the most recent, the end of July. So the gray line is a year ago. So you saw the rates, long rates jump up and then they both back down. And that's how it had corporate plans, trying to scurry what's happening with rates. But just to give you a sense of what's been happening from the interest rate perspective. And then on page 7 shows the different segments of the fixed income market.
So it's amazing actually on this treasury yield curve.
Yes.
It looks so dramatic, but the left-hand column is still 1.5 in the middle.
It's still 1.5.
It's not like, it is true that it's magnified, but yikes.
Right. Just for comparison's sakes, because maybe this will come up later, but I was looking what was the treasury 10 years ago, and the 10-year treasury is like 3.39.
Sounds incredible.
So big shift lower on the whole curve, and that impacts future returns when interest rates are this low.
Sure.
Yeah. And page 7, and I'm happy to jump around, but page 7 is on the left-hand side of page 7, looking at the different segments of the fixed income market. So that's where you see treasuries and government securities negative on a year-to-date, which is the middle column, or 1 year, which is that line green with rates falling. Investment grade credit, which is still part of the Barclays Ag, is doing a little bit better. You see they're flat or up 1.2%, but that's really because interest rate spreads or spreads over treasuries have compressed. And they're really at close to all-time tights. And I think about a year ago, we did talk about maybe to get some more yield, we could invest in investment grade credit, but really the yield over treasuries were just so minimal, it just didn't seem like the right time. Not that we know what's gonna happen, but we're talking about closely historically tights. High yield market's different, but they have, the high yield spreads haven't been as compressed in 20 years. So.
Today, just in the anecdote,
Yeah.
Somebody called me today with Goldman Sachs, 2 years, triple B plus, 0.6.
Goldman Sachs, triple B plus.
And that's a triple B plus, it's a ICO rating, right?
Right, right,
So you're not getting rewarded for that.
right,
Oh,
right.
So what's the answer? Yeah, that's it, but
Yeah, right. I mean, there's no silver bullet, right? What's happened for public plans, more on the state level, not that I advocate, you see more of a shift to alternatives. So you see plans using more private credit, more private equity, because of the forecast being above that of the public markets. Not that that's needed here, but I mean, if there was a trend of what's happening in this low rate environment,
yeah.
it's just pushing everything out around the risk
So
spectrum.
one question we might have, if we ever want to do that, but boy, it's another world.
It's a completely other world. And I would say, if we had ground we had to make up,
Right.
Yeah.
Yeah,
that might be a difference. But given where we are and to your point earlier in the presentation, given where our funding is,
Right.
we have the ability not to have to be so intrepid.
Yeah.
I think we can just sit and we can be a quick second. We don't need to be a bold first into an area. You know what I mean?
Yes.
It seems
We've
to me-
always been in that position, luckily.
Yeah.
I mean,
It's good
forever.
fortune for sure.
Right. Yeah, that's what prudent management does, is you have to take less, less risk. You don't have to go out.
but you still have this problem, like, you have to have some fixed income component.
Yeah,
And if rates don't change, taking it out of the equity piece and putting it into fixed at marginal yield.
marginal yield, and then you factor in inflation, so real rates are negative, so that's the consideration.
Right, the
So
reallocation, right, the reallocation will automatically force you to continually assess that trade.
Exactly.
Right.
For sure.
Better said.
And to that point, also just stay on 7 for a moment, you see high yield markets up, up 4-10%. So you see a lot of investors going to high yield. But to your question about keeping fixed income in the portfolio, the reason for fixed income allocation is the ballast, is to protect against March of last year.
Right.
Okay, so that's why we don't advocate for going towards high yield, or if we did, we would consider that more of a return-seeking asset, similar to equities, because in those down markets, high yield falls apart, and that's not what you want your bonds to do.
Right.
So as far as the allocation is I think still prudent. The other trend we'll talk to later is that public plans, across the country have been lowering the discount rate, given where we are in the valuations of the market, given where we are for interest rates.
Right.
And so that's the trend is of lowering discount rates. Mhm.
Small, little by little.
Incremental, yes. I mean, there's always impacts, from the financial, what it means to your contributions. And so just gradual. Yeah, and that's not necessarily what we're, I don't think the actuaries even recommending at this time,
No,
but it's usually gradual. Some might make a bigger step than others, but it's an individual, town decision.
well, they're on the summer schedule too next year, right?
right, next July 1st, 2022 will be the next valuation. And if you were to make a move, that's what
We'll be thinking.
the
about it.
actuaries
Yeah,
said.
right.
You wouldn't do it now, retroactive this year, it
right.
would be then.
But what is entering into public funds minds right now is with the strong returns like you've seen in your plans, is that's boosting funded status. When you'll probably come out with a new capper later, it's boosting the funded status, and therefore plans are taking that time to reassess. Again, and looking at the discount rate. Great, while we have a jump in funded status, while we have the time that, the expected returns is not as high as the last 10 years, that's why it's discount rates been coming down.
Yeah.
So that brings, us to page 8. So both June and July for all 3 plans. Just as a reminder, the pension plan and the OPEB plan have the same target asset allocation, so the actual allocation is not going to be the same because there's different cash flows. Mainly in the pension plan, there's a lot more cash flows than the OPEC. But staying here on page 8, market value 180 million. I looked at it, what it was last fiscal year, we were at 146 million. So that's what that 1 year return of 25.9% means as far as dollars.
It's amazing.
Yeah, and that's also, I don't have the 1 year cash flows. I wrote down the year-to-date cash flows, but we had about 2 million into the pension plan, like 4.7 million out. So, you know, negative, that's in a calendar year to date, not, I don't have a fiscal year, though I could get it. So just
I
wanted to
have that,
reflect
not
that.
with me, but I could get it
Right.
ahead of the next meeting.
Okay.
So again, you know, that 1 year number, that fiscal year, 25.99%. You see that's actually slightly over the, you know, the composite benchmark. How could that be with an index portfolio? You know, that's taken advantage. You know, we did some rebalancing last year when we hit the targets. So as a reminder on the bottom of page 8, you see the policy targets. 42 for US equity, 23 for international, 35 for fixed income. And we set bands of plus or minus 5% at the asset class level. So equity, total fixed income. And anytime we move outside that 5%, that's when we rebalance. And we're monitoring your asset values on a daily basis. That's just what we do. So when we see that, I usually let Diane Shell know we're going to rebalance. And so that disciplined rebalancing is, you know, leads to, works well.
Yeah.
And just as a reminder, we set it at 5% because we feel like anything over 5%, we chart to change the risk profile of the plan. But anything tighter, you know, you're just going to have more frequent rebalancing. Not that it's a bad thing, but it's going to be more frequent. And so that's where we're at with 5%.
Okay.
And you can see, you know, we're within those bands right now.
Yep.
Page 9 just looks at the actual returns of the individual funds. We have the 3 funds. You know, the big standout in that 1 year column is that US stock market. So it's up 44% in that 1 year time frame. Not far behind, but still behind is international equities, just up 36%. I say just, but so that's driven the lion's share. The total bond market index, which is benchmarked to the US aggregate, you know, that's what you see down slightly, 0.4%. Those are the 3 components. Page 10 is just looking at the OPEB and very similar return profile, just slightly more, you know, in the sense that the 1 year return was 26.09, so 10 basis points over the pension. It's really attributed to, if you look at the actual asset allocations, it's a little bit more over equities. So coming closer to the rebalancing band, it's, you know, 4.1% over target for equities, and the flip side on fixed income. So they really mirror each other.
Yep.
Page 12 is looking at the Marsley Trust. Returns again, very similar, a little bit higher. It's, you know, so the 1 year return was 26.81. And that's reflective of a very subtle, slightly more equities in there. It's 2/3 equities. So the target is 66%. So again, that just a little more in equities is why you have a slightly higher return of 26.81 on a 1 year basis, but also very close to targets.
Heartbreaking where we started. Oh my God, it's such a bad state.
The Mildred Marsley Trust.
Oh, yeah, the
Yeah.
Board of Ed, believe it or not,
Mhm.
they begged us, and I begged the Board of Finance at the time to take it on. It was really going nowhere, but down.
This is good, right?
Oh, this is like a miracle from heaven.
So you look at
I
that.
mean, we need to remind them, we should send this and remind the Board of Ed. I mean, well, nobody would remember, but still, somebody might.
And you look from a year ago, you know, just rounding was 1.3 million. So I mean, you're growing that corpus over time, which means as the corpus grows, you know, the income from the portfolio will be higher. So I know the income goes to pay the scholarships.
Yeah.
Any questions, you know, on any of the plans or back to any of the market performance? Okay.
I mean, it'd be really hard to come up with some negative questions.
Right, well,
No,
You
this
know,
is,
the biggest question I have is how long can this last?
yeah, that would be my negative.
Well, Diane and I were just talking about that. I mean, there's always something that surprises everyone, even the great thinkers. But, you know, I think the big thing that creates volatility in the market is what happens with interest rates. It's all about what the Fed's going to do. You know, they've indicated that they will look to taper probably their bond purchases by the end of the year. But there's no sign that they're going to accelerate interest rate hikes, which is still going out to 2023. So I really think that's what the market's looking at, of any sign of interest rate hikes.
Yeah,
Mhm.
I think the question for us will be, what will we do if it does correct? Let's say there's a 30% correction
Right.
and it's 3 years. Will we sit here every year and say, let's, just, you know, we take the long view. It's you feel you can do something.
Yeah,
But I just worry about it when it happens.
Are you anticipating that kind of correction or anything close?
We're not anticipating correction. I don't know if we would be able to call it right, but what we could say is just everything seems stretched. I have a slide in the back as far as the equity valuations, and the US equity market seems more stretched than the international markets. And so we've been, you know, where there's appetite and there's some room, increasing international equity allocations for some clients. And so again, I'm looking at 10-year difference. To give you a sense, the US equity market over the last 10 years up 16%. And the international market's only up 6%. And so a big driver of what drives returns in the market is earnings. Of course, you know, you need earnings, but also is valuations.
Yeah.
And the valuations of the US market are that much more rich than international. So no, we're not calling any type of correction. It's just the odds are become higher when you're in this territory.
Hey, Brian, this is fantastic returns. I just have a quick question, and maybe it's a policy issue. I know a lot of people I work with, clients, are looking at multi-strategy alternatives, right?
Right.
As a balancing, as a hedge against the equity market going down, given fixed income is so low.
Right.
Are we allowed to invest in like a multi-strategy alternative fund, which includes like real estate, debt, you know, infrastructure investments, commodities, as a part of our portfolio? Because I'm really worried, like you said, if there's a correction, we're giving up all the gains and we don't have a hedge against a downside of the equity market right now.
Right. Yes, and so from what I'm aware is that there's nothing to prevent you from investing in all those. I mean, we could think about all those individual asset classes as far as the portfolio construction, you know, one by one, whether it's real estate, commodities, etc. So I don't think the answer is right, Diane. I don't think there's anything preventing you, but each one of those other asset classes comes with its own risk. I think, Neil, you're correct. I mean, sometimes you feel like you have to do something, but the approach of taking the long-term view has worked out really well for the town and its plans.
I think it's a really worthwhile question, Michael, to ask, and we should discuss it, it seems to me, because as Neil points out, we could be confronted with a serious correction, and when you're in the middle of it, you don't want to be scrambling for what do we think. We ought to know where the limits of our comfort are, where our confidences lie, what makes sense in that regard.
Right.
But I would say if you look at last year as encouraging, I mean, these are spectacular numbers, and yet 35% of our portfolio was flat to slightly down.
Right.
And that's because of the diversification and the policy on asset allocation, whatever. And so, yeah, we could have had a monster year if we, put 100% into it. But I would think that policy and that allocation protects us in some measure on the downside. And so, but I do think we need to be prepared on what we do, as you point out, at some point, what do we do? Are we just going to kind of wing it, see how we feel at the time? I think there's probably a little bit more process and learning and just getting our own feel for our own comfort levels around this, because there could certainly be a role, as you say, in some of these, multi-dimensional funds or whatever that have the ability, I'm not saying go out and invest in Oriental carpets or something, but still you could, there is a role for real estate, there is a role for some of these other,
Right,
Yeah, so that, you have some alternative investments, don't you?
we do, we do. I mean, for our clients, we have private equity, which we launch with our partner, well, not just our partner, but Harbor Best up in Boston, who's been investing in private equity, the private markets for over 30 years. So that's who we've chosen as our partner in private equity. And then we do have access to private real estate as well. It's a firm called IDR, and they've taken a total approach towards investing in private real estate, meaning they invest in each of the underlying managers that make up the Odyssey Index, which is private real estate. So private real estate is certainly an option as well. And we
Brian, do you
all-
have like a fund? Do you have a fund that kind of, I'm not talking about, because each of those categories have its own risk, right? Just like you invest in each stock, there's a risk. So you invest in the index. I'm talking about investing in multi-strategy alternative fund, which would have a blend of hedge funds in it, a blend of private equity, a blend of real estate, a blend of infrastructure, a blend of private debt, so that all of a sudden they all kind of have a overall tolerance of one thing going after offsetting another. And these multi-strategy alternatives have shown at least to be effective when equities go down. And in our case, usually you have a fixed income to offset it, but I'm worried about the situation where the interest rates goes up. As interest rates goes up, your fixed income is going to go down. If interest rates and inflation goes up, your equity is going down. You have no hedge against this portfolio, whereas a multi-strategic alternative fund, which has all the things we talked about versus just investing in private equity, would kind of balance that out. So I don't know, do you have multi-strategic alternatives fund that encompasses all the things we talked about and not a separate private equity fund?
We don't have a multi-strategy fund that encompasses both public and private markets. We do have a multi-strategy fund that incorporates, think of it more as a multi-strategy hedge fund.
Yeah.
But not something that also includes real estate in it, private equity in it,
Okay.
not both public and private markets. So there is a multi-strategy fund. It's called the Alternative Strategy Fund, open to our institutional investors. And that's the thinking behind it, to provide some of that downside protection. But for anyone that's held it for the last 10 years, they've been quite disappointed in the strong returns in the equity markets. And this fund has been quite flat, right? So it has been flat, just because of how well everything else is done.
A lot of higher education universities do that. They're high ratings, double A, triple A best ones, and they still have all these requirements,
Right.
Meet that criteria wise, and then that has performed better during certain years. But I don't know if we have the stomach for it,
I agree with you, but to Michael's point, and then going to something you said, Brian, which is, if you've been holding it for 10 years, you might be disappointed, but that's not the player on the team who we think is actually going to be pumping up our average. The role of that player in the portfolio is to make sure that we're not giving back everything when the scenario, as Michael lays out, is now, look, we got nothing helping fixed income and equities are tumbling and that kind of thing. What part of it is going to be a buoyant aspect of, because everything's going to, and so maybe there is, like I agree with you, I wouldn't have a stomach for it.
For the town, it's been, just looking at last year as that great example, the first quarter of last year, that was your fixed income portfolio of 35%, which held up well. And then again, that we did nothing is that then we bought more equities back in that March timeframe, and that helped that 20-year. And then we rebalanced again in November of last year. So that's where that rebalancing, that discipline of buying when that opportunity presents itself in the markets throw out of whack.
Yeah, that's true.
But when is it the right time to buy an opportunity like this? Now, when
Oh,
everything else?
yeah, I don't think
Or
we
not.
ever pretend to know when the right time to time. And the studies that we've done is that that market timing over time has hurt investors. Not cheap. So when we have some brilliant PhDs and economists as part of Vanguard, but they don't try to pretend that they can call the market.
And like REITs are one thing, but I looked at one deal which was a pool of hedge funds where you didn't even get to pick the hedge fund. The experts, they appoint an expert, and maybe they're an expert, but,
Yeah.
you know, I can't imagine us doing that. You'd have to, unless it was panic in the streets,
Mhm.
and if there's panic in the streets, it doesn't make people run for hedge funds. I don't
Yeah,
know.
we had the panic last year, you know. it's just-
But you know, the point on hedging, like, we really don't have, our hedge was, you know, equity and fixed income.
Correct.
And one played the other, one played the other, one, both are in a bucket. And could correct at the same time. What do we have that offsets at? The answer is kind of like,
Yeah, well, I mean,
And that's the discussion to have.
yeah.
Because we don't have to have it now, but we need to be prepared for whenever it is. And I think Michael makes a good point.
Yeah,
It could be a good role for us.
That's a good point.
we've been in this vicious cycle for 10 years. Anytime that there's any kind of scare or rates go up a little bit, the market falls, then in comes the government, cuts rates, starts buying government securities and does QE again. And so we just keep been in this circle, and it's almost been like good news is good news and bad news is good news, because that means the government's gonna step in and buy things. And
Well, that's.
I don't know.
But, that's the last 10 years, Brian, and we've been in a real good upswing last 10 years, but we can't, got to go back more than 10 years. We go back 70, 80 years. That's not the case. And just because we've been lucky or fortunate or blessed in the last 10 years, I'm more worried about, you know, a market correction and a market correction. You say, yeah, we'll go back in 30 years, but a lot of our pensioners may not be around 30 years. They want to know their money's good. And my view is we really should look at a hedge against, given how well we've done. We just can't keep rolling the dice and say, well, it's been great for 10 years. So let's just assume we'd be great for another 10 years. Because you know that's when we get arrogant, and that's when we actually have losses. So I'm much more say, hey, let's be happy we had a great 10 years. Let's hedge it a little bit so that if there is a market correction, and I've heard you know, bankers talk about a market correction of 20 to 30% possibly if there's a negative global event that we haven't predicted. And if you want to say, well, if there's a negative global event and equities go down 30% by hedging our portfolio and we only go down 10%, then that's a win for us, I think.
Right. So I'd be glad to do that for the committee, you know, look at this multi-strategy fund as one way to protect and put it into the portfolio and just show different scenarios of how it would be on the upside and the downside. So I'm glad to do that.
So let's, Diana, we
Yeah.
put that on?
Yeah, we can
Okay.
work on that.
Yeah.
and-
Sure.
What's the composition of this particular alternative strategy fund?
I don't know. It's, you know, it's like 6 different strategies that they kind of put in there, incorporate, you know, some commodities, some interest rates, some, you know, shorting or market neutral. So it's 6 different strategies of different risk premium that they're trying to capture, but therefore a multi-strat fund
Right.
has different components.
Yeah.
And I don't know what the particular weight is. Commodities is in there. You know, those weights will shift over time.
That's great. If you give us information on that, Brian, that'd be helpful, right?
Okay.
And run some scenarios too. That would be great.
Yeah, it could provide information on the fund, but it could also provide information on the scenarios from a modeling perspective.
Right, that would be good.
and
Okay.
your timing on this, just so I know, to have Brian come back to you all.
Well, we should have a meeting before summer.
You think?
Yeah, I'm gonna be strict about this.
If you want to have another before budget season.
November, December.
I think after budget season, don't you think? I mean, we're gonna
Well, then
start
that's February.
February.
Yeah,
January?
Is that fast enough?
maybe not.
Ideally, if we could have one later this year, you know, and
But yeah, budget doesn't begin in earnest until February.
February.
You want to try to do one before the end of the calendar year.
Yeah.
Squeeze one in.
Yeah.
I'd be good with that.
Yeah, that sounds good.
Okay,
If you can get us some information, you know, maybe, you know,
just at least
Halloweenish.
send it out,
And then
okay.
we'll have another meeting. Does that make sense?
Yes.
Like November at some point.
Yes, I think that's good. Let's try to do it in
Okay.
November.
Okay, good.
Okay,
All right,
Glad
so,
to do that. The other slides, they're all identical, it's just that I rolled it forward to, you know, just showing the July, just 1 month of the fiscal year,
Yeah.
so it's another 80 or 90 basis points that added in the month of July. And then if I just cribbed it because it didn't have an August performance report, but, you know, if I look calendar year to date through the end of August, you know, the pension plan's up 10.8, pension, the OPEB is up 10.89, and Marcy's up 11% calendar year to date through August. So again, incremental more returns in July and August. So in the second section, or really slide 22, is where we're looking at a forward-looking forecast, given the policy targets. So the target rates are on the left-hand side. And then to the right of those policy targets are our capital market forecasts for each of those asset classes. And we provide a whole distribution, but you know, you could think of the 50 as the median point for each of those asset classes. So that's where you could see, you know, US equities over the next 30 years, we're forecasting 5.3%. You could see that bigger jump with 8% for non-US equities, and then US bonds. So when you look at it, you know, combined and taken into correlations, so the return distribution in the middle of that section, at the 50th percentile, we're saying, you know, that portfolio would return 5.69. And then we always provide a distribution. Actuaries always look at a distribution. So, you know, at the 75th percentile, you know, going up high, you're coming up at around 6.4%. And only at the 95th percentile, you know, the real tail, do you get, you know, at 7.45. So this is the distribution, you know, that's helpful to the actuaries that help set the, you know, discount rate. And, you know, we can run, and I have, you know, looked at all different scenarios, but that's to give you a sense.
Yeah, in terms of the model.
In terms of the model, and again, in terms of the distribution, because you don't ever want to just pick one point in the forecast, because it's never going to be exactly right. It's never going to be exactly at the median.
Right.
Yeah.
That would be interesting to see it.
Yeah, so this is for both pension and the OPEB, because they have the same asset allocation. Page 23, we update this on an annual basis. This is more informational, right? You know, you never set your discount rate a bit, what other towns are, because every town has a different funded status, etc. This gives you a sense of what other towns in Fairfield have as a discount rate using last year's financial statements. So on the y-axis, we call percent in return seeking assets. And we say return seeking because we would put something like private equity there. We would put high yield there. It wouldn't be just equities. So that's the y-axis. Think of that as your riskier assets. And then on the x-axis is your discount rate for all the different plans. I know, you know, or at least from 19 to 20, Darien brought their rate down, Ridgefield brought their rate down, and I don't know what they're doing as we come to 21 fiscal year end. But the trend has been, you know, moving the discount rate down.
So we're in the middle.
You're in the middle. I mean, so the other dimension on this chart is the colors, and kind of put them somewhat arbitrary, not completely, but the green, you know, anywhere is looking at the funded status. So those are the plans that are over 90% funded. The green, you're even higher, closer to 100. So again, you're in an inevitable position, enviable position compared to some of these other towns and cities. You know, my observation is, yeah, there's some plans that have more return-seeking assets and a lower discount rate, and you have like a Stanford or Norwalk that, you know, also have more in return-seeking but a higher discount rate. So it's just to give you a sense. We update this.
Seems like a moving school of fish, you know, everyone just wants to move together and sort of be in the
Right.
in the circumference of all the peers, which is fine.
Right. And because they did it for the pension OPEB, the Marcy Trust is here on page 24. The numbers again look pretty similar, but you know, they don't have to put anything in the financial statements, but it gives you a sense of what to expect.
Refresh my memory, were they able to add stimulus money? Any of them? They did for New York City, right? Were they able to
Into-
get into the pension?
into any of these pensions in Connecticut
Well,
or any?
Connecticut or elsewhere? Was it
I
just the big city?
thought that the federal stimulus money was supposed to not be used to funding any pension
Yeah, I
obligations.
think
That's
that's
what we
right.
were originally told.
That, I
I
mean,
read-
I don't know if there's ways,
I
you know,
don't
so
know how to-
any of the stimulus money should not have gone to paying down, or improving your pension.
or
status.
paying
Or
down
paying
debt.
down debt, I
Yeah,
think
both,
they-
those were the
Right, it
two
was-
parameters, yeah.
So that's what my understanding is.
Yeah.
One trend with some public funds at the pension, not the OPEB level, is some cities are issuing pension obligation bonds to improve the funded status of their pension. But, you know, these are cities, like City of Tucson did it, the Phoenix is looking at it, but they're talking about, you know, their funded status might be 50-60%. And so they're seeing a low interest rate environment, they might be able to borrow for 2. And, you know, if you look at an expected return of, you can get to 5 or 6, you capture that arbitrage. But, you know, so some plans have done that.
Yeah, you'll be desperate to do a pension obligation.
Oh,
Right.
wow.
Right, you have to be desperate.
Mhm.
And, you know, that's because the rating agencies, you know, look at that.
Yeah.
You know, see how poorly funded they are and then downgrade for that.
Well, they're funded with equity, it's interesting, they're probably down a little kick,
Mhm.
but we're way above that.
So hopefully that helps.
We're-
Yes, yes. And the last section, I just put in some information, just high level, I didn't put a lot of slides here, just as far as, you know, outlook. I think really the big ones are inflation and interest rates, and we touched upon them a little bit through this whole conversation. You know, so our mindset coming into the year is, you know, is that the inflation would jump up because of all the stimulus, both federal, you know, and monetary, and also because of the low base effects from 20. And so that's certainly been the case. You know, we've seen those big inflation numbers. It's been a little bit higher than we thought, but still we continue to think that inflation numbers will trend down through the end of this year. It's that, you know, while we thought last year we would get to below 2% in 2021, we think that looks more like the beginning of 2022. But, you know, as far as the overall components, it's still, we still see it as transitory. You know, the risk, if anything, is on the upside. I think one of the risks we're watching is just what happens with more federal stimulus. That's the one that could push inflation higher, and also what are consumer expectations. If the consumer expectations are higher inflation, it could feed on itself. And then therefore, we still don't, you know, we're of the following the Fed's view of interest rate hikes not till 2023.
Okay,
And that's the quick summary.
yeah, no, I think that's good. So you'll be hearing this presentation again.
I'll try to do a
Well,
bridge
quicker,
version. A bridge
15
version.
15 minutes.
Yeah, we can move it along. We interrupted with questions.
Yeah,
But that's what you're supposed to do.
Right,
And
yeah.
they will too.
No, it'll be a bridge.
It's
version.
fine.
It is fun. It's,
particularly in returns of.
yeah, it's funny thing about fun.
And that make you feeling good. huh?
Yeah, I mean, I put the fact sheets for each of the 3 funds in the back and,
Yeah.
you know, again, you know, even following a passive portfolio, you haven't given up.
The timing is great that we lock it in for time to recover too, right? We can move back to the median for many, so they're waiting usually corrects it, right?
What was that last part?
Waiting for.
Oh, wait,
Yeah, waiting, time is on your side.
yeah,
They don't have a put on them where you have to go out for the money tomorrow.
that's right. That's right. Yeah, no, that's fair.
Do you want to adjourn the meeting, given that it's 7:45?
Yes, I
Or-
think so. Let's have a motion to,
I so
6:45.
moved to adjourn.
and Mike was a second, I see a hand up. And that's it.
Okay,
Are you on Zoom there tonight?
I am gonna,
Mike is.
Great.
okay, I'm gonna end the video, and then,
Great.
is that okay? Unless there's any other-
Yep. Thank you, Brian. Much appreciated.
Thank you.
Thank you,
All right.
Yeah.
Bye-bye.
bye.